Disappointing jobs data leaves the economic recovery in question. Tech stocks underperform as yield curves steepen, and commodities signal price pressures might be getting out of control. All this and more in this week's Macro Insight. All right, so welcome back to Macro Insight, everyone. Today is the 11th of May, and let's take a look at these markets. So the main event last week was non-farm payrolls. Obviously, a pretty big disappointment. Market was looking for something like 1 million jobs added. We got something like 250,000. So initial knee-jerk reaction was in the bond market where yields sold off across the curve. But then pretty quickly, the longer end of the curve kind of reversed back down, whilst the shorter dated Euro-dollar futures part of the curve kind of stayed where it was, stayed put, taking down the probability of hikes, right? So essentially, markets saying that the Fed, kind of giving the Fed the green light to stay loose, and not be in a rush to hike rates, which is what they keep saying they're not going to do as well. And then equities took that as an excuse to rally, right? So equities took that as an excuse to rally because it means the Fed is on hold because they're going to wait until job growth picks up, right? Whereas the bond market, looking at it from a slightly different perspective and saying, well, you know, the longer the Fed stays loose, we're eventually going to get inflation, and the bond market just kind of went back to where it was and actually saw higher yields, right? We go to the bonds, have a look at what the yields have done. So 10-year yields, if we zoom in there, you can see on that knee jerk, 10-year went from around 157 down to 148 briefly, right? But recovered all the way back. And now we're seeing yields in the 10-year at about 161. Same sort of thing on 30-year, big knee jerk spike down to 218, and now we're seeing it all the way back up to 233, right? So bond market definitely significantly lower than where we were before non-farms. Whereas if you look at the 2-year, you kind of see nothing like that. I mean, you did still get a bit of a bounce, but nothing like the bounce that we've seen in the longer part of the curve. So what we're essentially seeing is yield curve steepening. Yeah. If we go to the equity market, kind of show what happened there. There you saw we got that rally above 4,200, and yesterday we got to kind of highs of 4,250 even before the market just rolled over. Right now, in terms of the catalyst for what's kind of made the market roll over, you know, we had got back into that 42 to 4250 zone that we had said the market's probably got quite a lot of long gamma exposure. You know, the guys I've been speaking to at SpotGamma have been tracking that. But basically, the comments from the ex-Fed guy Dudley, ex-Fed official Bill Dudley, saying that 4.5% peak Fed target rate isn't out of the question. And he's pretty much, you know, last week the market had a wobble on Yellen saying that rates might need to go up, and then she backtracked. Well, Dudley just come and said exactly the same thing, and he said that rates might need to go even higher than she was maybe indicating, right? So market getting spooked on that. Obviously, yield curve steepening and tech stocks leading the way down. Yeah, so you saw a brutal day in the Nasdaq, but some of those growth tech stocks, the longer duration tech stocks, got absolutely killed, right? And then as you see the S&P chart here, that volatility trigger that we were talking about, where the street kind of runs out of gamma to the downside, was kind of around 4180, and we've accelerated through that, and we're back down to 4135 levels now as we speak. Now, I've highlighted some key supports that I put together today to see where we might find some support in this market. Now, you've got the big old level of 200-day moving average at 4120, and you've got the first you got the first Fibonacci confluence level that I've got marked out here at 41.30, which is kind of exactly where we bounced last week on that wobble, right? So definitely at an important level here. If this level breaks, then I'd expect, sort of somewhere between 41.20 and 4100 to be that kind of next area. So pretty close by, but there's some quite key supports around these levels on the S&P. Yeah. Vol has also been pretty high. So if we look at the VIX and see what that's been doing over the week, right? That's been bouncing around between this 17 and 21, 22 area. And every time it spiked, it got sold back down pretty quick. And even over the weekend, it got sold down pretty heavily, but look, we're straight back up there again, right? So vol extremely high. And that kind of makes sense because if the street hasn't got much local volatility around here because we've sold off, if we rally back, they're going to kick into a load of Greeks and they're going to be sellers of vol. And if we continue to go down, they're going to be kind of scrambling to get some vol on board. So you're going to see quite a lot of sensitivity to spot moves in what the vol does at the moment. So I suspect vol is going to remain quite high. If we can manage to bounce like we often do, later on in the session, and we manage to pop our heads back above 41.80, which feels like a fair distance away right now, but it's only really just over 1%. If we can manage that, then the VIX trade, the VIX short trade is probably one of the better trades because it may still have some room to head back down towards the low end of that range, right? So keep an eye on the VIX, see how it trades if we get a bounce, and that may well be the way to play any sort of, normalization if it was to occur. Yeah. Other ways to play this market if you're looking for a bounce would be, given that the vol has popped, would be things like call ratios, maybe to May, because we're saying there's a lot of gamma on the upside in May around that 42.50 area. So 41.80, 42.30, 1x2 will probably look quite attractive to buy in May. And then alternatively, for retail guys where you can't really, there's quite a lot of margin requirements for 1x2 call ratios, then maybe you look at something like a call fly. So 41.50, 4200, 4250 call fly, 2-player bounce from here will offer you something like a 5-to-1 risk reward, and you'd get that short strike around 4200, which we might gravitate towards into next week's expiry if markets can kind of consolidate here and bounce off these support levels, right? So that's what we're looking like on S&P and kind of VIX and vol. In terms of the other US markets, NASDAQ and Russell have been underperforming, obviously. NASDAQ, like we said, because of what's going on in yields and that kind of tech space being under pressure on the back of that. But you've also got Russell, we had a weak jobs number. So that puts into question maybe the recovery and how strong that recovery is. And the Russell seems to be very much geared to the domestic growth story and the reopening story. So Russell and NASDAQ both feeling relatively heavy compared to, say, the S&P. And in terms of sectors, the leadership has been coming out of the likes of the financials and the energy stocks, right? Those are the sectors that have still been actually performing and been rising. Okay. Now, me personally, I was running a long Russell short NASDAQ spread because I believe that was the sort of best way to find value and play a reopening type dynamic. Now, I've closed out all of my NASDAQ shorts on this sell-off. And what I've done with my Russell long is I've taken down about half of it, and I'm running half of it as just a long delta exposure. And I'm running it with a stop at around 21.40, right? So right now the Russell's sitting at around 21.60, so about 1% away from my stop. If it takes that out, I think, there's a chance that all hell breaks loose and this market could have quite a lot more downside, so I don't need to be long. But for me, if we're going to get a bounce, it's going to kind of kick in within the next sort of 50 basis points. And so having that Russell long, I'm okay with right now. Yeah. So that's where we are in terms of what I'm doing with my kind of US market positioning. If we look at the NASDAQ chart, I do think there is a decent zone of support between kind of 1300 and 3200 right now. So NASDAQ futures are kind of sitting right in between that at 13100 right now. So I think there's some support in this area. You've got an uptrend, you've got a major sort of uptrend line. You've got, You've got that moving average that we've kind of just gone through, but obviously we haven't closed through yet. So you've got a few things kind of maybe suggesting that we might find some support here. But if we take out that 1300, not 1300, that 13,000 area, you know, with any kind of conviction, then that could open up quite a lot of room to the downside in NASDAQ, right? So something to be careful of, I would say. And again, like I was mentioning, call ratios or even call spreads, that sort of trade would work on NASDAQ as well if you wanted to get long, because the volatility is relatively elevated. So that allows you to get that upside exposure and take advantage of that vol on the upside. Yeah. We had mentioned Europe last week, saying, you know, is Europe the kind of the equity trade now in terms of, you know, if US growth is going to peak in Q2, but Europe's going to peak in Q3, you know, is that where the acceleration still needs to come in terms of growth? And is the market going to start to switch out of US positioning into Europe, right? And if you were also bullish on the euro and you thought the dollar was going to remain weak, one way of playing that, rather than say the major European indices like DAX, might be the ETF on Germany, right? So EWG. So you can see last week, you know, that kind of did get down to some of our support zones and recovered very strongly off that level from sort of 33.80 all the way back up to 35.5. It's coming off again. That market's delayed, so it's not open yet. It's probably about 2% lower now, but that may well provide you with another sort of dip buying opportunity if you believe in that European sort of story. You know, Goldman's put out this chart, basically looking at their kind of, this is a GS growth forecast, where you can see, you know, month on month what they're expecting in terms of GDP, and you can see some big numbers in their expectations for like June, July, August, right? So if we start to see those sort of positive numbers coming out of European GDP, then yeah, that could be your catalyst to take some of these European markets higher and for them to outperform right over the summer. Yeah. Okay. What else? India. So the Indian market has been recovering despite things looking pretty bad on the ground. Yeah. So obviously it's a market that I've been liking for a while. I'm still actually managed to hold on to some longs there. They're actually back into positive territory. If you look at what's going on in the vaccine rollout globally, yeah, if you see this chart, we've got obviously the UK and US have smashed it in terms of, you know, percentage of population with immunity. Now they're claiming something like 70%, 70, 80%. And then you've got EM been lagging behind. But in terms of the trajectory, we're talking about 20 million doses going out globally per day at the moment. And that's going to accelerate into the summer. And you can see EM having a big catch up, right, over sort of the back end of the summer. So the market's kind of looking past what's happening on the ground, looking at the trajectory of vaccine rollout, seeing that in EM it's accelerating massively as well, and kind of giving the market, giving those stock markets the benefit of the doubt, right? And then on that note, if we again talk about India, you've got this chart here. So this chart shows you the relative performance around peak lockdown measures, right? So it's kind of showing you what Brazil and Poland have done. And if they're kind of like a proxy where they just went into crazy harsh lockdowns more recently, their stock market, their local stock markets kind of bottomed around that sort of peak lockdown. So India's kind of gone through that and is now bouncing out the other side. And if that follows the trajectory of what Brazil and the Poland markets have done, if you think, you know, they were the ones that were particularly hit by COVID there recently, then that bodes quite well for performance in the Indian stock market. And then on top of that, you've got dollar weakness, which is generally quite good for EM stocks, right? So you've got a few things lining up quite well for that India trade to start to actually do quite well, despite what it looks like on the ground. Yeah. All right, so that's kind of my thoughts around sort of EM markets, Europe and US equities. Yeah. In terms of what's coming up this week, We've had the German zoo survey that was quite positive today. You've got another Fed speaker, Brainard, talking today. You've got UK GDP, US CPI is going to be a big number tomorrow. Everyone's going to be looking at, given that everyone's, worried about inflation right now. And then what else have we got going on? We've got US PPI on Thursday and US retail sales on Friday. So quite a decent amount of economic data. And it's going to kind of give you, a sense for whether these recent inflation fears that the market has, are going to be, something to worry about or not. What's going on in the FX market? So the dollar has been breaking down recently. So, dollar was clinging on for dear life, but, I've been kind of flagging this weekly chart as the main one that it needed to kind of hold on to. It was kind of the last stand in the dollar, right? And it was clinging on to this uptrend on the weekly around that 90.5 area, and now it's taking it out. Yeah, so that the kind of catalyst to take that out to the downside was that poor jobs number. So dollar feels very, very weak. Yeah, and I had also said that if we get the dollar kind of break those support levels, then I suspected that positioning, people were going to jump on that dollar short trade, right? So you've got some positioning data here showing you net positioning. And whilst, since January, some of those shorts have been taken down, you've seen the re-emergence of shorts happening. And that's been happening, like I say, as those markets have been breaking down, that support's been breaking down, people are re-engaging with that short, yeah? So we bring up the kind of chart in some of the other major pairs, GBP, that 140 level had been kind of capping it, and now it's taken it out. So taking out 140 in style, the kind of news on that was the Scottish election, the way that went. So making the odds of kind of a Scottish referendum to leave less likely. So that was kind of a positive catalyst for cable. And then in terms of euro, you've kind of started to get close to attacking this 122 level, right? Again, the whole European recovery story, gathering pace, vaccinations gathering pace. So people are thinking, euro outperformance may be on the horizon, and that's good for euro as well, right? So that's kind of what you've been seeing in FX land. In terms of my views, I do think dollar weakness probably persists, to be honest. Even in the latest risk off that we've seen in markets, dollar's gone nowhere, right? Normally you'd expect the dollar to bounce on a global risk off like we saw in the last 24 hours, and it's literally, it can't bounce. So for me, the price action in dollar looks pretty shocking. And so it may well be a case. And if you look at what shorter dated yields are doing, given the bad jobs number, that's kind of going to anchor shorter dated yields in the US, even if the long end starts to sell off. So I think that will probably keep the dollar under pressure. Yeah, that's just what I suspect. Yeah. And then you may actually even get some capital flowing out of dollars and into other currencies on the back of a bond market sell-off in the US, which also is dollar bearish, right? So at the margin, I would probably remain dollar bearish. Yeah. Okay, so that brings me on to commodities. So weak dollar continues to help commodities, obviously, but it's much bigger than that, right? So the Bloomberg spot commodity index is up 60% year on year, whether it's ags, whether it's metals, whether it's oils, you're getting massive moves in all commodity prices, right? And this is all happening at a time when China's credit impulse has been slowing, right? So generally, China's credit impulse is a big driver of what's going on in commodities and what's driving that demand. And even though you're seeing that ex-China demand that you're seeing in like steel and iron ore markets and things like that, and the way they're exploding, kind of shows you that other countries and other markets are taking up the slack, even if China has been slowing a bit, right? So that's definitely what we're seeing in commodity markets. And those are signaling to us that while the Fed keeps on calling for transitory inflation, some of these price moves are looking pretty worrying, right? And for sure, they're going to be passed on to consumers. Yeah, and that's already happening, right? So that's kind of the main sort of overriding theme within commodities, and that's driving these inflation fears to some extent. Yeah, you also got obviously gold, which has had a bit of a move recently, although today it's giving some back. So we had gold, you know, in that range for a while. I was saying the level it needed to break was kind of 1825 was the first level. And then the next level was around that 1850, 1860 area, which is this big downtrend line that has been holding it, right? So if it got above 1860, then it would be a case of, okay, we could well be, you know, targeting back above 2000 into the highs over the summer. But given, you know, that I mean, and why has gold been rallying, right? It's been rallying because bond yields have been relatively stable over the last month, and break-evens have been rallying, right? Inflation break-evens have been rallying, and that's because inflation expectations have been tracking what commodity prices are doing. So that's helped gold. And then also the weaker dollar has helped gold, yeah? But I don't know, I still think that there's room for yields in the US, certainly in the longer end of the curve, like 10s and 30s, to go higher. And if that happens, I think that will take real yields higher, and that will mean gold will probably struggle to break that upper resistance, right? So I still think there's a good chance gold kind of gets contained by that 1860 level. And you look at price action today, you know, it's coming back down below that 1825 level. So it's kind of rejecting that breakout. So, you know, for me, the jury's still out on gold. I'm not piling back into a load of gold. I had de-risked taking down my gold exposure quite a lot in my pension portfolio post-vaccines, and I'm not jumping to kind of buy it back just yet. I'm kind of in a wait and see mode because I still think there's some room for real yields to go higher, and that won't be great for gold. Okay. And then, yeah, we mentioned break-evens. Break-evens are back to the highest level since 2005, right? Inflation break-evens. So that's pretty big news, and that's kind of what's driving a lot of this inflation fear, right? And you're seeing it play out in that market. The only other sort of thing I wanted to point out was copper. It's obviously been having an amazing run, you know, parabolic type run. You know, if you look at the assets that have just been killing it, things like lumber, copper, crypto, obviously. But okay, but yeah, in copper, I think, you know, this bearish candle that took place yesterday in copper made me a little bit nervous on copper. I mean, I've got copper in my long-term portfolio. I've been accumulating it for a while. I bought a clip down there at 390, which worked out pretty well so far. I'm not doing anything with that. That's a long-term hold for me. I'm a believer in the copper demand story and the kind of the electrification of the economy and all that stuff. And I think there's a shortage of supply that will remain. So I don't think the copper story is going to die. But that candle where you had the super high wick there and it gave it all back and ended down on the day, those are never nice candles to see, right? And make you a little bit nervous that there might be some short-term correcting that needs to be done. Also, that they did raise margins apparently on futures exchanges within commodities, and that might take some of the speculative kind of froth out of that market, given that people have been chasing that rally, right? So something to keep an eye on. If it corrects, you know, I've highlighted these levels, 450, 430, 417. Those will be the levels that I'm looking at in a correction. Maybe I'll add, depending on the price action, you know, if we got down to that 430 level, maybe I'd consider adding some tactical longs, but my long-term position is going nowhere in copper right now. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.